What is up, YouTube? Welcome back to Stacks by the Numbers. Today is Wednesday the 6th, and I'm coming to you. It's about 1:30 right now. I wanted to talk about a situation we spoke about a few months ago that is now working out very nicely for us. Name of the company we're talking about, Campbell Soup Company, ticker symbol CPB, listed here on the New York Stock Exchange. Stock right now trading at about 43 and a quarter, hit a high here, 43.56 here today, up almost 3 points, a little over 7%, still holding here. And the reason why, in my opinion, this company is seeing this bump is because of profitability. And of course, the new holiday shopping sales season is off to a good start, as they said. Plus, profitability is potentially going to be ahead of schedule compared to with what analysts expected for 2024. So let's get into it. This is when I first brought the company to your attention. We were in this descending wedge. We spoke about earnings coming out. As we see, EPS basically in line, revenue basically in line as well with a slight beat. And we can see we had to pop out to the high 43s there. If anyone got in and took that trade, congratulations. Obviously, after that, markets continued to sell off here throughout September and October. The company hits a low of 37.94 and then has a bounce off that level and goes into kind of a downward consolidation channel going into these earnings coming out here. And as we see, revenue basically in line with a slight miss. EPS comes in roughly 4% above analyst expectations. And this is why, again, this basically goes back to the Buffett method, which, again, I will remind you, Warren Buffett is the most successful investor in the country, of course, aside from Nancy Pelosi. But more importantly, this is what he does. He looks for brand name companies, your Campbells, your ExxonMobils, your Disneys. You wait for the market to beat them up, and then you buy a brand name stock at a fair valued or undervalued discount. Don't make it harder than it is. Work smarter, not harder. Now, any of you who, after my video, bought CPB calls, like, with 2-3 weeks expiration, and if you happen to take a loss, well, that wasn't really the play there. And again, this is the problem, because we've become so accustomed to short-term trading and trying to do everything with options to make as much as we can, as fast as we can. And the problem is, all you have to do is get a couple of plays wrong, and then your account is destroyed. So this is why, regardless of how much money you have in your account, unless of course you're literally starting with $200 or $300 and you have to do short-term spec plays, if you're sitting there with thousands, tens of thousands, hundreds of thousands, if the bulk of your account is in speculative, naked calls and puts, in my opinion, you're a fool. Because if you ask any financial advisor, any person on Wall Street, anybody, even though a lot of them are slick salesmen and try to just generate commission for themselves, in general, people in finance, we know the rules of accounts, right? Like, one rule is you shouldn't risk more than 5 or 10% of your account in one position. So any of you out there who have like 50 or 80% of your money in one position, that's a mistake in my opinion. But also at the same time, I'm not saying that, speculative plays like buying, small cap stocks or rolling the dice on some calls or some puts. I'm not saying that this shouldn't be done. But it really shouldn't be done with more than like 10 or even 20% of your portfolio. Obviously, everyone's financial situation is different. But more importantly, if you just don't like doing shares and you insist on doing options, obviously, to each their own, and I wish you nothing but success. But the one thing I will say is this, which I've said multiple times. It is much easier to buy time on your options and just wait for your move and not have to worry about short-term volatility, as opposed to, the NASDAQ is down, I'm going to buy QQQ calls for this Friday. Right? Like that's silly. That's silly. Because unless you're really confident and have seriously high conviction that something like the NASDAQ will climb the next day or two, what you're basically doing is you're hoping, right? You're taking the position and you're essentially hoping that you're right. But when I saw something like Campbell Soup down here at 41, 40, 39, in my mind, I knew I was going to be right. And that's the difference. That's the difference. Now, again, of course, this one happened to work out, so obviously, I look better than you thought I would have or whatever. But this is why I always say time trumps strike price. So don't try to predict a rejection or a breakout. Just look at the overall situation and try to estimate how much time it's going to take. See, people are so obsessed lately with price levels. What price do I buy this? What price do I sell this? Where is it going to go? How high can it go? What's the price target, right? That's all people care about. Oh, what's the price target? Everyone wants to buy at the low and sell at the high, which I've said time and time again, you are never going to time the low and you are never going to time the high unless, of course, you're the man behind the curtain who has that type of information. So in a situation like this, if we basically, quote unquote, knew or had very high conviction that something like CPB, Campbell Soup, was undervalued and is going to increase over time, then all you have to do is buy calls with time. And now you've basically eliminated your stress. You, again, really don't care about short-term volatility. And if you did position yourself here in calls and then you wake up and it's down, at 38.5, if you want, you can add to the position. Or on the flip side, you don't care because you still have time and you just wait for your move. Similar on the opposite side as well, when we looked at something like Luminar Technologies, ticker symbol LAZR, right? We found that stock, it was at like 6.5 or 7. And I said, in my opinion, I have pretty high conviction that this stock is seriously overvalued and it's going to start dropping. It's going to go back down to a couple of dollars. It's not supposed to be this high. So what do you do in that situation? Do you buy puts for that week, next week, because I made a video saying that in my opinion it's overvalued? No. If we know, quote unquote, have high conviction that a stock is overvalued, all we have to do is buy puts with time and wait. That's all you have to do. Which, again, of course, I know a lot of people may get upset after I say that because, you might say, well, I have a small account, I'm trading with like $600. I can't afford to buy 6 months worth of time out there. I understand. That is why when you have a very small account, unfortunately, you usually have to take on more risk. And it also goes back to that old tale that the more money you have, the easier it is to make. Because those of you who have to buy speculative short-term options, imagine if you had another 0 or 2 in your account, you'd maybe be able to buy shares instead of options. Or you'd be able to buy 3 months of time instead of 2 weeks of time. And this is why I laugh also when I see these videos of these people with these thumbnails like, oh, I just made $5,400 in 12 minutes. It's like, yeah, good move, great trade. Unfortunately, what you're not telling people is you put like $150K into speculative options. And, you caught a pump on a nice candle and you were in and out on like a 1.4% move. And listen, granted, obviously, you have to give credit where credit's due. Because if someone slowly grows their account with a strategy like that and gets all the way up to a couple of 100,000, again, got to give credit where credit's due. However, on the flip side, from a financial standpoint, to take a position like that is ridiculously speculative. And of course, if you notice, they never post their losses, right? Because if you put that much money into a speculative, volatile investment vehicle, like a derivative, the main word for stock option, derivatives, but like no normal person would do that. And of course, no financial advisor would advise you to do something like that, to take a move like that. So again, if you notice, those people who take those moves, miraculously, they only have winners. Because they know when they're wrong, by putting that much in, they immediately lose 30 or 40 or 50,000. So obviously if they post that they just got, they just got the call wrong and they just took like a 47K hit, they're not going to let you know that, because what that does is that basically wipes out all the wins that they made for the last month and a half, right? But anyway, long story short, basically it technically does go back to the old rule. The more you have, the easier it is to make, because again, if you were able to buy shares of this instead of trying to time calls, you're in a safer position, a more stable position. If you're looking at something like Apple and you think, oh, in 6 months the stock's going to go higher. Yeah, it cost an arm and a leg to buy that much time on a lot of these stocks. However, if you have more money and you could afford time, it is now easier for you to take advantage of future growth. You understand what I'm saying? So that's why a lot of you out there who are like trying to time like index calls and puts for like this Friday, believe me, I feel your pain, because we've all been in that position. But any of you guys who have like 20, 50, 100,000 and you're still rolling the dice with like weekly options, or you're waking up every day just checking the earnings calendar to see what the earnings plays are, you are not, now using that strategy, you are not an investor, and technically you are not even a trader. You are just strictly gambling. You are a gambler. And it's really sad when you hear the stories of people who tell you, oh, I had like 200K, now I'm down to like 18,000. People tell me, oh, I had an account with like 90 grand, now it's at like 5,000. You need to know that, yes, there is money to be made in the short term. But first of all, you have to be in and out. Again, trader's market. But more importantly, when you make money, you should be slowly siphoning pieces of it into longer term holds. Right? So let's just say hypothetically, you bought calls on CPB a couple of days ago. You wake up, the company beats earnings, boom, you just made whatever, we'll call it 100%, 150%, right? You just doubled up your money real quick. What you technically should be doing is taking the bulk of that profit and rolling it into a discounted stock for the longer term side of your portfolio. Right? Stocks like Fubo. Or if you wanted to build a position in something like LAC, in anticipation that in the end of 2024, going into 2025, they're going to start mining that lithium and bringing in revenue, and the stock's going to climb up to, $11, $13, $15 a share over time. That is what these profits are supposed to be used for. It's not, oh, I put 100 in CPB calls, now it's worth 250. Oh, but if I put 250 in QQQ puts, I can make 800. No. You are doing it incorrectly. And you are now throwing a strategy out of the window and literally just trying to risk what you just gained to potentially immediately lose it in another speculative play. And I'm telling you, this is why the average person watching these videos loses money whether the market is up, down, or sideways. A lot of people think, oh, market's going up, everyone's making money. No, it's not true. Remember, it's an auction market. In order for someone to make money, someone has to lose money, right? But anyway, just went off on a massive tangent. But basically, what's happening here, Buffett method, look for brand name companies, buy them at a discount. Campbell Soup basically saying that profitability may outpace Wall Street estimate for 2024. Where is it? Right here. Looking ahead, Campbell Soup expects adjusted 2024 earnings of $309 to $315, ahead of estimates of $307. Company spoke about cost cutting. Here we go. Total cost increased to 2.16 from 2.14 billion. Company said it achieved $895 million of total savings during the quarter under its multi-year cost reduction program. Continues to target $1 billion of savings by the end of fiscal 2025. They also announced that they had a very good start to the holiday season, right? Now, very important. This is why I'm saying, given some time, potentially even by next quarter, we could have a rebound back here to key level of 46, potentially back to the bottom of the gap here at 48, and even 50 plus over some more time, because they came out, and again, profitability on a good path, very nice. But also the fact that they said that the bulk of volume came in during the holiday season for Thanksgiving. And if we look here, we can see that this quarter was the period ending October of 2023, right? Thanksgiving is in November of 2023. So this again is adding to the pump and the rally here today, because the company is now saying they're cutting costs, they're, ahead of profitability expectations. Oh, and by the way, starting now, moving into this next quarter, we're off to a great start. Thanksgiving weekend, whatever it was, we saw good volume in sales. People came out, they bought our products. Phenomenal. Plus, they also mentioned Sovos brands, which they recently acquired, saying they're going to finish and close out that acquisition here in 2024. So now, that's going to be a slight bump in revenue as well moving forward. So this is why, again, I know it's very stressful. And listen, no one is ever going to go 10 out of 10. A lot of you may see me do these update videos and, I get the calls right. And listen, I am not always right. I did a video a while back on NVIDIA saying it's heavily overvalued. The stock kept going higher. I did a video on Eli Lilly saying, in my opinion, it's overvalued in the numbers. But hey, it kept going higher. Now markets recently went higher. Stock was on a tear. Palantir. I said Palantir was overvalued in the numbers. A lot of you online were talking about it. A lot of you piled into it. And then what happened? The company came out with positive news ahead of schedule. And that's why the stock exploded. So in my mind, I'm looking at the numbers saying, no, it's probably going to go down. And then the company comes out and says, oh yeah, by the way, we're about to go net income positive, and we beat on EPS, we beat on revenue, we're kicking ass, I'm increasing guidance. It's like, holy crap, you just came out, you hit us with like 6 positives. So yeah, I ended up getting that one wrong as well. So no one is ever going to go 10 out of 10. But this is why I tell you guys, if you utilize the Buffett method, I'm telling you, in my opinion, it is going to work out for you over the years. Because we've all gone on runs for a couple of weeks or a couple of months where it seems like every call you're making is just dead accurate. You're seeing phenomenal returns in the options market, right? Nothing can stop you. You're all the way up. And then what happens? A bad day, a bad week, a bad month. All of a sudden, you're down more than you were up, or you're back where you started. And what do we always say? If I was a little more conservative with it, I'd still have most of my money. Or, I knew ABC stock was going to climb. Why did I keep doing options? I should have just put the whole account into ABC stock and just let it grow for me over time. This is what I'm talking about. This is what goes back to my original advice here earlier in the video. In my opinion, when you do options trading and you make short-term profits, that is phenomenal. For you to not take some of those profits and secure them safely in something more stable is foolish. And if you're sharp enough to continue to do well with options, regardless of the environment, and you're consistently seeing growth, well, then you should also consistently be adding to your long-term account as well. Because remember, when the dark days, when the red days do come, what you'd like to have are some stable, solid investments that could potentially still be growing while your options money is getting eaten alive. And you can turn around and say, yeah, I made a bad call on, Disney puts, it keeps climbing, but I own shares of Fubo and it's been doing really well this year, so that's balancing everything out. This is another reason as well why you must be diversified. A lot of people out there say diversification is foolish. Well, that's not true, because as we know, a lot of these sectors are very cyclical. Consumer non-durable foods go down, but materials are up. But then, materials are down, but metals are up. And then metals are down, but tech is up. And this is why they talk about diversification. Because if you have a little bit in each sector, then it's almost like no matter what's happening, you're able to take advantage of it in some way, some form. Right? But anyway, going off on a tangent, again, in my opinion, overall, I think CPB keeps going higher. Switch over to stock charts real quick before I let you go. The video's longer than I wanted it to be, but here on the daily, we can see we crossed on the MACD, of course, with this big pop. We're out above the top Bollinger Band here. In my opinion, again, this 200-day 46, I think that's a layup, in my opinion. Unless markets really begin to sell off, then they might keep CPB flat or bring it back down to the low 40s, but I don't know. It seems like everyone's pretty bullish and pretty amped up here, looking for just continuous climbs going into the new year. Looking here on the weekly, we can see we crossed there to the upside a couple of weeks back. We are now above the mid-Bollinger Band here on the weekly. And again, in my opinion, see how it bounced hard off of this 200-day moving average before breaking down here? That's probably, in my opinion, where it's going to regain. So we have our 200-day on the weekly at 44.76 and our top Bollinger Band on the weekly at 44.96. That's why I feel 45 should be no problem. The moving average on the daily was 46, should be no problem. And even here, the 50-day moving average of about 47 on the weekly should be no problem. RSI a touch over 50.5. We do still have room to grow. But here on the daily, we can see RSI approaching 68. So we could potentially have a little bit more green tomorrow, but then chances are the stock could potentially top out and flatten out or even sell off here, trying to retest this top Bollinger Band of about 42, letting the RSI adjust, and then potentially bounce and take the next leg higher to approach some of these moving averages. But overall, Campbell Soup, CPB, this is why I make these videos for you guys. And I just hope, even if you didn't get involved, I want you to understand the why. Why did I like it? Why did I make a video? Right? Why was I saying it was undervalued? But yeah, went off on a tangent, but I'll end it there. So once again, this is Stocks by the Numbers. I want to thank you guys for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually very quick to reply. Thumbs up algorithm helps me get more eyes on the channel. And of course, subscribe to the channel. That is our handshake agreement. That is how you help me help you. But more importantly, moving forward, like I always say, I understand that markets are rocky. They're very volatile. They're very uncertain. But I want to wish all of you success. I hope everyone makes a couple of dollars. Thanks for stopping by. Have a good day.